This lecture is over risk, the cost of capital, and capital budgeting. I'm your professor, Dr. Stephen Haggard. So far in this class, we have just been using whatever rate we were provided to work problems. In the real world, numbers are not just handed down to you from the gods of finance. We have to figure these things out for ourselves. And that's the purpose of this lecture. We're going to learn how to determine the appropriate rate of return required by a project based on the riskiness of its cash flows. So how do we determine this discount rate for our project? Well, it turns out that we have these things called financial markets where different financial instruments are traded. And based on the return patterns of those financial instruments, we can determine their riskiness and their expected return. And so what we're going to try to do is use the financial markets to find something of similar riskiness to our project and figure out what the market requires as a return for that instrument. And we'll use that on our project. Now, that's simpler than reality. Turns out that firms are financed with a mix of debt and equity. So if we're going to figure out what investors are demanding based on the riskiness of the firm, we're going to have to figure out what the cost of debt is, what the cost of equity is, and the proportions that are in the capital structure. We're going to use all that information then to determine what the appropriate discount rate is for a project with risk identical to that of the firm. First, we need to be able to figure out what is the cost of the firm's equity capital. Every firm has equity in its capital structure. There is no such thing as a 100% debt firm. And so this is important for every firm that we come across. Even though firms are not required to pay dividends, their equity still has a cost. Investors expect a return. And if you recall, there are two ways that equity can provide returns. The first is dividends, and the second is capital gains. Either way, this is a cost to the firm. So we have two ways to determine equity cost, and if you recall these from earlier in the semester, there is the CAPM, or capital asset pricing model, and the equation expression of that model is the security market line. And the second way is the dividend discount model. Here is the security market line. It's the expected return on the individual security, that's the sub-I, is equal to the risk-free rate plus the beta on that individual security, once again sub-I, multiplied by the market risk premium. What's the market risk premium? That's the expected return on the market minus the risk-free rate. So previously we were given all this information, which made things easier, but it doesn't work that way in the real world. We're going to have to produce an estimate of the risk-free rate, an estimate of the market risk premium, and an estimate of the equity securities beta. Let's start by figuring out how to estimate the risk-free rate. Typically, finance professionals use the annual yield on the 3-month U.S. Treasury bill. Now, is that always the case? Well, your book suggests using the 1-year U.S. Treasury bill yield, which actually does not match up with what I have seen in the finance literature. Some suggest using the 1-month U.S. Treasury bill. After all, it has less interest rate risk than the 3-month U.S. Treasury bill. But the problem is that the 1-month U.S. Treasury bill is just not very popular, so it doesn't trade that much, it doesn't have that much liquidity, and the values on this bond are not updated as often therefore, and it makes it hard to get a recent realistic estimate of the annual yield on it. And so it really makes it less attractive for our estimating purposes. For the purposes of solving homework problems or exam problems, you should just use whichever Treasury bill yield you are given. Now we move on to estimating the market risk premium. Recall that we typically use the S&P 500 as our proxy or substitute for the market portfolio. After all, we cannot replicate the market portfolio. And so we're going to use the S&P 500 as our stand-in. We can determine the return on the S&P 500 using historical data. So that would be some sort of arithmetic mean. And we'll use that as our stand-in for the expected return on the market. But this leads to a judgment call. How many years of return data do you average in order to find that? In other words, do I use 1 year of data, 5 years of data, 10 years of data, 25 years of data? We have all the way back to January of 1926. So you'll need to make the judgment call on how many years of return data do you use. And the next question is, will the future look like the past? As of this recording, the economic future of the United States looks very different than it did just 4 years ago. And so would it be meaningful to use S&P 500 return estimates that involve the booms of the 80s and the 90s? Who's to know? We can't predict the future with certainty. So once we have that expected return for the S&P 500, we can find the market risk premium, or our estimate of it, by subtracting the risk-free rate from the return on the S&P 500, which is our stand-in for the market portfolio. Next, we need to estimate beta for the equity security. Beta for the firm can be estimated using linear regression. Recall how we use Excel to determine the beta for GE for the year 2007? The problem is that betas tend to vary over time, and so you're stuck with a choice. You can either choose between an estimate of beta over the most recent period, which might be more indicative of the current beta of the stock, but that limits the sample size that we use for our regression. If you recall from your statistics classes, statisticians love larger samples. Why? Because you can get a better estimate of something the bigger the sample you have. Unfortunately, our sample here is collected over time, and so you're trading off between the statistical accuracy of the estimate versus the temporal accuracy of the estimate, because the further you go back in time, the less likely that your estimate of beta will represent what's currently going on at the company. This is the trade-off that you have to consider when you're estimating beta. Of course, if you are working with a company that has not changed in the least over the last 10 years so far as their betas go, and you don't see anything moving into the future that would make their beta different, then you would want to use that whole 10-year time frame in estimating your beta to get a better, more precise estimate of beta. Okay, so we've talked about the security market line, or capital asset pricing model. That's our first way to determine the required return on stock, or the cost of equity. The other way is the dividend discount model, and that's just a reorganization of that formula that we used earlier that said that P0 was equal to D1 over R minus G. And so we're going to rearrange that. R is equal to D1 over P0 plus G. Now, keep in mind, this only works for firms with a constant rate of dividend growth. And it only works for firms that pay a dividend, because otherwise there's no D1 to put in there. And so this model would work for actually a very small subset of all firms. Now, along the way here, you're going to have to estimate G. And we can do that one of two ways. We can either do it by the historical growth rate in dividends, which we could easily figure out just looking at historical dividend data, or by taking the retention ratio and multiplying it by return on equity. Recall that we did this when we were examining the NPV-Go model. Now that we've found the cost of equity, we need to be able to also find the cost of debt. And to find the cost of debt for a firm, we simply examine the required yield to maturity on the firm's publicly traded bonds. In other words, GE sells bonds to the public, and they're traded, and those values get reported. And since we know how to calculate a yield based on a bond price, its coupon rates, and its maturity and all that, we can figure out what yield is required for those bonds. And we can use that yield as the required cost for debt. Now, if the firm has no publicly traded bonds, you can always call your friendly neighborhood investment banker, and they could give an approximation of what yield the market would require for the firm's debt given the firm's current level of riskiness. Now, this may sound far-fetched, but I actually have a friend who worked at a company called Calpine, and it was his job to help that company raise money for projects. And he would call up his investment banker at Goldman Sachs and ask this very question: if we were to sell bonds today, what kind of yield would we have to pay? And what would be the best kind of securities to issue? And investment bankers actually must be fairly good at this in order to make sure that the investment bank makes money when they agree to underwrite or issue a firm's debt. Okay, so one thing you need to keep in mind though is that we use yield to maturity, even though an effective annual rate might make more sense. Remember that yield to maturity is an APR. It doesn't take into account compounding that happens within the year. Nonetheless, we continue to, as a matter of convention, use yield to maturity. The other thing that you have to keep in mind is that interest is tax deductible. So we're going to have to make an adjustment for that because, after all, we are only interested in the after-tax cost of debt. Now we're going to put it all together to come up with a single number that represents the cost of capital for the firm. We call this the weighted average cost of capital, or WACC. To determine the firm's cost of capital, we need to take a weighted average of the cost of equity and the cost of debt. Plus, we have to account for the tax deductibility of interest. And so the formula you see here, our weighted average cost of capital, is simply a weighted average of the required return on the debt and the required return on the equity. Very similar to what we saw when we were looking at beta of the asset is equal to a weighted average of the beta of the equity and the beta of the debt, with one difference. This time we're going to multiply by 1 minus t sub c over in that debt term. And the reason we do that is because the interest on debt is tax deductible. Notice that T sub C is the corporate tax rate. Think about this. If I have to pay $1 in interest, that's $1 less taxable income that I must report. Let's say my tax rate is 25%. That means that for every dollar less of income that I report, I pay 25 cents less in taxes. And so the interest there did not actually cost me $1. It cost me $1 minus 25 cents in taxes. It actually only cost me 75 cents to pay $1 worth of interest. And so that's why it's important for us to make that adjustment to the return of debt. Let's do a WACC example. Your firm is financed with 2/3 debt, 1/3 equity. Remember, those weights always must add to 1, and in this case they do. 2/3 plus 1/3 is 1. The return on equity is 15%, the return on debt is 12%, and the corporate tax rate is 25%. All we have to do is enter this information into our equation. So the terms are 1/3 times 15% for the equity side, and then for the debt side we have 2/3 times 12% times 1 minus 0.25. And when we do the math out, we can see that the first term comes out to be 5%, the second term comes out to be 6%. When we add them together, the weighted average cost of capital is 11%. Now, here's something that students often get confused about. They say, wow, if debt is so much cheaper, perhaps we should just use as much debt as possible. Here's the problem with that line of thought. RWAC actually represents a return required based on the riskiness of the underlying assets. And so if we do additional amounts of funding over on the debt side of things, it won't lower RWAC. It will in fact raise the required return on our equity. Remember that our equity beta goes up with leverage? The required return on equity will go up as we add leverage. We're not going to save anything other than the modest tax savings. And so the whole decision process between equity and debt boils down to balancing that tax savings versus the increased probability of financial distress. We have to balance those out. So far, we have been talking about projects that are just as risky as the firm. For instance, Nissan building another Nissan Sentra plant. The Nissan Sentra is a proven technology. It's been being produced by Nissan for many years. It is just as risky as any of the other internal combustion engine products that Nissan makes. However, let's think about the Nissan Leaf. The Nissan Leaf is an electric car. That's a new technology. And the Nissan Leaf uses laptop batteries, basically, to store the electricity. Now, what do we know about laptop batteries? They have a tendency to explode or catch fire. And the batteries in electric cars are located, for purposes of the center of gravity, they are located beneath the passenger compartment. Do you see the potential for increased risk with the Nissan Leaf versus the trusty Nissan Sentra? As a result, the Nissan Leaf project should require a greater rate of return than a new plant for the Nissan Sentra. How do we determine the appropriate discount rate for such projects? Well, the first thing we could do is to find a pure play firm in the field of the new project and use that firm's RWAC as our discount rate for the project. In this case of the Nissan Leaf, we're very fortunate. Tesla is a pure play electric car company using very similar technologies as the Nissan Leaf. And so we can just go out and determine Tesla's RWAC and use that as our discount rate. A lot of times it's hard to do that, and companies may in fact have a simple setup where they have their weighted average cost of capital, and projects that are riskier than average require an additional 2 percentage points on top of that, and safer projects use a rate that is 2 points down from RWAC. It's not very scientific, but it does make some adjustment for the riskiness of projects. Many corporations have a single corporate discount rate that they use for all projects. When I worked for Halliburton, our corporate rate of return was 11.9%, regardless of the risk of the project. My group made subsurface safety valves, which are basically just metal tubes with springs and O-rings, so basically 19th century technology. Across town in Fort Worth, Texas, there was a group that made logging tools. Now, don't think of it like logging as cutting down trees. Think of it as sending a sophisticated electronic device down a well bore to examine the rock formations to determine where the oil and gas was and how much of it was there. And so these sophisticated electronic devices probably had about as much brain power as your iPhone. And keep in mind, this is the early 90s. They would bombard the formations, and the computer would crunch the data and send the information back up the wire. Now, what sounds like a riskier undertaking? Making metal tubes with springs and seals, or putting together these highly sophisticated electronic instruments? It turns out it's actually quite riskier to put together the electronic instruments. Think of what happens when you drop your cell phone in a toilet. It doesn't last for very long. Now imagine trying to get your cell phone to survive in an environment with hundreds of degrees of temperature and hundreds of pounds per square inch of pressure and noxious sour gas. It's very difficult to do. The problem, though, was every time these folks undertook a project, they would be able to get their project accepted because it would return more than the corporate rate of return of 11.9%, even though it should have been rejected. On the other hand, I would put forward projects that return slightly less than the corporate required rate of return, and those projects would get rejected even though they were profitable based on the risk of my operation. And that's what this picture is all about. Notice that we have basically the security market line, and the required return for projects is also determined by the SML based on their beta. The beta of my projects was actually fairly low, and the beta of their projects was fairly high. And so my projects didn't require as much return as theirs. But under the corporate system of a single required rate of return, their unprofitable projects would get accepted, that's the one on the right-hand side, while my profitable projects would get rejected. That's the danger of a single corporate discount rate. You end up accepting a lot of unprofitable high-risk projects while rejecting profitable low-risk projects. And over time, what that means is the assets of your firm become riskier and less profitable. One area that commonly confuses students is flotation costs. Flotation costs are simply the money you have to spend to raise capital. Whenever you sell securities, be it stock or bonds, your investment banker takes a cut. In fact, what your investment banker does is buy these instruments from you at a discount and then sells them to investors at full market value. The difference is how the investment banker gets paid, but it's actually a cost to you because if you could have sold these directly to the investors, you would have gotten that money instead of the investment banker. So it's a cost. Flotation costs are higher for raising equity because it's riskier for the investment bank. Why is that? It's something called inventory risk. When the investment bank buys the equity off of you, the chances for the price of that equity to change dramatically while it's in their possession or inventory is much greater for equity than it is for debt. And so flotation costs, therefore, are higher for equity than for debt. Flotation costs are considered up front as an expense at the beginning of the project. They do not impact the weighted average cost of capital. It's sad, but many students will take the weighted average flotation cost and add it to the weighted average cost of capital and make that their discount rate for the project. That's absolutely wrong, and you should never do it. So we're going to figure out a weighted average flotation cost for the firm. Now, when you figure flotation costs for a particular project, you should always assume that you raise funds in the same proportions as your current debt-to-equity ratio. Why should we do this? Well, probably your firm is attempting to maintain a target debt-to-equity ratio. Sometimes students think, since debt is cheaper to raise, that we should just fund the project with debt instead of equity. That way our flotation costs will be lower. However, eventually, what that's going to lead to is the firm moving away from its target debt-to-equity ratio and having to go out and issue a bunch of equity in order to get that ratio back to where they want it. And so they're eventually going to have to spend those flotation costs anyway. And so what we do is we just go ahead and calculate our weighted average flotation costs based on the firm's current capital structure. Of course, we couldn't go very far without throwing an equation in. After all, this is finance. And what we have here is F sub O, that is the overall flotation cost. It's going to be a percentage. And we calculate that using the flotation costs for stock, F sub S, and the flotation costs for bonds, F sub B. And we use the same weights we've been using throughout this lesson to determine our overall weighted average flotation costs. Now, note that there's no 1 minus T sub C here. It turns out that the tax deductibility of flotation costs are the same whether you are raising debt or equity. The only difference we see in taxation between those two is in their payout of interest and dividends, not in their flotation costs. Here's a final note before we move on to calculating our flotation costs. If you are using internal equity, that is, retained earnings, your flotation cost for that equity is 0. And in that equation that we just looked at, you would just set F sub S to 0, and that entire term would drop out, which makes funding your project cheaper and determining the weighted average flotation cost easier. So here we work a weighted average flotation cost example, and you get to see how we include this cost in the project. The first piece of information you need to know is that your company is financed with half debt. If it's financed half with debt, what does the other half have to be? Equity. They always have to add to 1. And so the flotation cost for debt here is 5%, and for equity is 15%. So what's your weighted average flotation cost? Well, we just go ahead and put these numbers into our equation as shown and find that our overall flotation cost is 10%. That's the first step. The second step is to figure out in actual dollars how much we're going to spend on flotation costs. The problem states that we need $100 million. That's the amount of cash that you need to undertake the project. How much would you have to raise in order to get $100 million after flotation costs? Well, we come up with this little formula. The amount needed is equal to the amount to be raised multiplied by 1 minus F sub 0. After all, you're going to have to pay F sub 0 to the investment banking firm, so it's not money you'll be able to keep. And what we do is rearrange this thing and say the amount to be raised is equal to the amount needed divided by 1 minus F sub 0. And then we fill in the blanks. The amount needed is 100 million. F sub 0 is 0.10, and so when we do the calculation, 100 divided by 0.9 is $111.11 million. And so how do we fit this into the project? What we're going to do is use negative 111.11 million as our first cash flow, not minus 100 million as we would if there were no such things as flotation costs. Notice at no time did we add the weighted average flotation cost to the weighted average cost of capital.